January 28, 2021. Shares of GameStop, a dying mall chain that sells used video games, touch $483. 6 months earlier, they cost $4. The buyers driving it are not banks. They are a few million amateurs on a Reddit forum, aiming at hedge funds that had made one fatal mistake, betting against more shares of the company than actually existed. This is the strangest crisis in modern market history. For crises decoded like this, subscribe to Crisis Economics. Hold 2 questions as we go. 1. How do you even bet against 140% of a company? 2. When the rocket finally died, the whole internet blamed a murdered buy button and a Wall Street conspiracy, and what regulators later found is stranger than the conspiracy. Both answers are coming. Start with the company, because the company was a corpse. GameStop in 2020. Roughly 5,000 physical stores selling boxed games in a world that downloads them, in malls that a pandemic had just emptied. The stock fell under $4. To professional investors, it was the most obvious dying business in America, and there is a specific way Wall Street makes money from dying businesses. It is called short selling. You borrow a share, sell it today at $4, wait for the collapse, buy it back at $1, return the borrowed share, and pocket the difference. Perfectly legal, often useful, and carrying a hidden asymmetry. Buy a stock, and the most you can lose is what you paid. Short a stock, and your potential loss has no ceiling, because there is no limit to how high a price can go. Capped winnings, bottomless losses. Remember that. By late 2020, the funds were not just short GameStop, they were short 140% of its available shares. Here is the answer to question 1, and it is beautifully mundane. When you borrow a share and sell it, the buyer's broker can lend that same share out again to another short seller. One share, borrowed twice, counted twice. Stack enough lending chains and the bets outgrow the company. Nothing illegal happened, but it produced a mathematical trap. Sooner or later, the shorts must buy back more shares than exist. The exit door was smaller than the crowd inside the theater. Now the other army. In 2019, American brokers cut trading commissions to 0. An app called Robinhood turned buying stocks into something between a game and a slot machine. Confetti animations when you trade, a free share for every friend you recruit, and by 2020, it had 13 million users locked at home with stimulus checks and nothing to do. Their gathering place, a Reddit forum called Wall Street Bets, 2 million members treating the market as a multiplayer game with its own language, stonks, apes, diamond hands, to the moon. And underneath the memes ran something hotter than greed. The forum was full of people who had watched 2008 as kids' parents laid off, houses lost, banks bailed out, and GameStop was their childhood store. For a lot of them, this was not a trade, it was a rematch. In that forum, a mild-mannered financial analyst from Massachusetts, posting under a screen name we genuinely cannot say on YouTube, had spent a year being laughed at. Keith Gill had put about $53,000 into GameStop in 2019 with a boring value argument. Real cash on the books, a new console generation coming, a price that assumed death was guaranteed. Even Michael Burry, the investor from The Big Short, owned it early and demanded change. Burry, incredibly, sold before the fireworks. Then came the match. Ryan Cohen, founder of the pet food giant Chewy, built a 13% stake, and on January 11, 2021, joined the board to drag GameStop into e-commerce. The corpse had a pulse. The shorts did not budge. And 2 million people simultaneously noticed the trap you already know about. What happened next ran on 2 engines, so let's open them. Engine 1, the short squeeze. As the price rises, short sellers' losses grow without limit until their brokers demand more collateral, the margin call. To stop the bleeding, a short must buy shares back, but that buying pushes the price higher, which margin calls the next fund, which buys, which pushes higher. The only buyer more desperate than a believer is a professional who is trapped. Engine 2, the gamma squeeze, the theory everyone used in real time. The crowd was not just buying shares, it was buying cheap call options, lottery tickets on a higher price. The market makers who sell those options hedge themselves by buying the actual stock, and the higher the price climbs, the more stock the hedge requires.
Translation: a kid with $600 of options could, in theory, force an institution to buy thousands of dollars of shares. A lever on a lever with the shorts standing underneath it.
Watch the tape. January 13, GameStop rises 57% in a day. January 19, a famous short-selling firm, Citron Research, calls the buyers suckers and predicts a fallback to 20. January 22, nearly 200 million shares trade, the entire company changing hands almost 3 times in a single day. January 25, Melvin Capital, the most visible short, takes an emergency $2.75 billion injection from Citadel and Point72, in hedge fund language, an ambulance. January 26, after the close, Elon Musk tweets one word, GameStonk, to more than 40 million followers. January 27, the stock closes at 347. Melvin confirms it has surrendered its position. Citron announces it will stop publishing short reports altogether. Surrender in writing. Across Wall Street, GameStop shorts are down more than $12 billion in a single month, and the violence spills into everything. Funds dump their winners, their Apple, their Microsoft, to cover their GameStop wound, and the whole S&P has its worst day in months. A video game store is now a systemic event. If you're enjoying watching machinery snap in slow motion, that is exactly what this channel does. One subscribe keeps the series running. Then, January 28, around 5 in the morning, the phone call. Robinhood's clearinghouse, the plumbing that guarantees trades while they settle, demands $3.7 billion in extra collateral. Robinhood does not have $3.7 billion. Hours later, Robinhood and a dozen other brokers flip GameStop to position closing only. You can sell, you cannot buy. Demand is amputated at the exact top of the rocket. The stock touches 483, collapses to 112 by lunchtime, and within 3 weeks it is back near 40. For one surreal afternoon, Alexandria Ocasio-Cortez and Ted Cruz publicly agreed with each other, both demanding to know who ordered the button killed. By nightfall, Robinhood is facing dozens of class action lawsuits, and furious users flood its App Store page with so many one-star reviews that Google ends up deleting them by the 100,000. The forum's rallying cry was "Hold the line." Gravity had other plans. Count the bodies and the winners, because both lists will surprise you. Melvin Capital lost 53% of its money in January and was dead by 2022. Keith Gill's 53,000 became tens of millions, and he doubled down, on camera, near the bottom of the crash. But enormous numbers of small investors arrived in the final 48 hours, buying above $300, and rode it all the way down. And some of the biggest single winners were not Redditors at all. One quiet institutional fund, Senvest, walked away with roughly $700 million. The revolution, it turns out, had shareholders on both sides of the barricade. Now the account I promised, the conspiracy. The story everyone believed went like this. Citadel, the giant that had just bailed out Melvin and that also pays Robinhood for the right to execute its customers' orders, phoned Robinhood and had the buy button executed to save Wall Street. In February, Congress dragged the whole cast to a hearing. Robinhood CEO, Citadel's Ken Griffin, Melvin's Gabe Plotkin, and Keith Gill, who, under oath, clarified for the record that he was not a cat and that he just liked the stock. And then, in October 2021, the SEC published its autopsy and it dismantled the legend twice. First, investigators found no evidence that any hedge fund pressured Robinhood. The buy button died because of plumbing. American stock trades took 2 full days to settle, and during those 2 days, the clearinghouse demands collateral scaled to risk. GameStop's volatility turned that formula into a pre-dawn ransom note. Robinhood restricted buying because it was hours from insolvency, then raised $3.5 billion in days to reopen the button. Not a conspiracy, an exposed pipe.
Second, and stranger, the SEC's own data showed that buying by trapped short sellers was only a small fraction of total buying, and the price stayed high long after the shorts had already fled. Even the options data pointed the wrong way for a gamma squeeze. In the regulator's words, it was positive sentiment, not buying to cover, that powered the rise. And one detail quietly ruins the simple story. In late February, with the famous shorts long gone, the stock roared back above 200, a rally with nobody left to squeeze. Some academics still dispute the measurements, but sit with the official conclusion: the most famous short squeeze in history was, by volume, mostly not a short squeeze. It was millions of people buying because millions of people were buying. The crowd did not just trap the whale, the crowd became the whale, and whales move prices in both directions. So, what did it change forever?
Start with the pipe. In May 2024, American markets moved to next-day settlement, T+1, a reform written directly in GameStop's shadow. The 2-day window that killed the buy button no longer exists. Regulators worldwide re-examined payment for order flow, the business model of selling customers' orders to trading giants, and Europe moved to ban it outright. Melvin Capital no longer exists. GameStop does, because the company sold its own overpriced shares into the mania, raised nearly $1.7 billion, erased its debt, and handed itself to Ryan Cohen. Read that again. The dying store outlived the fund that shorted it. AMC, the meme sequel, pulled the same move and dodged bankruptcy. Meme stocks became a permanent asset class. Hedge funds now run software that reads Reddit before it reads earnings, and on peak days, retail traders were roughly a quarter of the entire market. Hollywood made the movie. And in May 2024, after 3 years of silence, Keith Gill posted a single wordless meme and added billions to GameStop's market value within a day. Attention itself had become a financial force. The lesson is not that the little guy always wins. Plenty of little guys financed the top of that chart. The lesson is that markets are now social networks with prices attached, that a crowd can be leverage, and that somewhere in every system there is a pipe nobody has stress tested until the exact morning it bursts. We opened what leverage did to the banks in our video on 2008. This is the same machine, pointed the other way. From $4 to $483 and back, and the machine is still switched on, sitting in your pocket right now. Crisis Economics takes these machines apart one at a time. Subscribe so you are here when we open the next one.